Not so long ago, many analysts believed a global recession was imminent, but we're now seeing what looks to be booming economies and equities at all-time highs. But this can't last forever, can it? Today we're going to be looking at whether traditional finance and global economies are actually doing too good. So obviously one of the major players on a global scale is the US, so a lot of these metrics will be looking at US specific, as they're usually a bit of a leading indicator in terms of macroeconomic trends in a global scale. So first and foremost, the high yield credit cycles. We'll look at the risk appetite and sentiment towards potentially more risky and speculative bonds. We can see it over the past few months has actually moved up very much to the upside, and we can see in all of previous Bitcoin cycles, this is pretty typical. We actually see a little bit of a bottoming out, and then we actually see this start to rally to the upside just before the halving event, pretty much as we're looking at now. And we can see this next halving event, which is only a few months away, just around the corner. We're probably going to be crossing this pretty much exactly like we've seen in every other cycle, which leads us to believe that this trend is to continue, that we're likely to see this rally very much to the upside, which has coincided with Bitcoin bull cycles as people look to more and more speculative, volatile, with upside potential assets. And this cycle is probably looking like it's going to be very similar to the last ones. And if we look at something like the manufacturing PMI, which again has very much correlated strongly to Bitcoin's most positive price action months, has now broken above a probable key resistance level at about 50%. I don't know if you can call support and resistance levels a thing on manufacturing PMI cycles, but realistically, this 50% level has been a very influential and turning point throughout all of Bitcoin's history. We can see it's rejected off it a few times, and in previous cycles, it actually bounced off this level. So us breaking above this probably looks to be a bit of a positive thing. And ultimately, if we look at the S&P 500, this is all reflected in that. We can see that the S&P 500 has hit year-on-year returns of 28%. The S&P 500 has hit new all-time highs, as have many indexes of global equities, specifically US equities as well, have massively outperformed. So really, things are looking good, or so it seems. Equities are booming, economies seem to be growing and doing well, but is this the case? Is this actually true? If we look at something like the financial stress index, we can see that this is one of the least stressful periods, supposedly, of financial stress in global economies since Bitcoin's inception. We can see it's reached levels right now of minus 0.84, which really, if we look towards, should be a good thing. Surely if things are good, we shouldn't be worried about the future. We should enjoy the good times, let the good times roll. But really, I think something we need to acknowledge is in every single one of these previous circumstances, it was not very long before Bitcoin saw this financial stress index start increasing quite exponentially. And where do these increases coincide with? Well, they actually coincide with Bitcoin's bear cycles. We actually see these financial stress massive increases coinciding with Bitcoin decreasing exponentially in price. So this isn't to necessarily say that this is definitely going to happen. Doesn't say that we can't remain in these low levels for an extended period of time. And previously, if we look towards this first instance in 2013 when we had a double peak cycle, this was only very much short-lived before we had another increase in price. So maybe we're going to see something similar to that. But really, when things are good, it sounds counterintuitive. We need to look to when they're likely to be bad again. And if we look at something like the US interest payments of the US federal debt, we can see that this is increasing massively, which really outlines a pretty major fundamental issue in not just the US, but many global economies, in that there is just so much debt. If we look to the US debt versus GDP ratio, this has actually started to increase again to above 120%. This is just more debt than makes sense, really. So really, economies in this situation, we can see, especially over the last few years, have taken towards the trend of just printing their way out of bad times, potentially taking on more debt than makes any sense. So really, even though economies are in a bad situation, we can see that actually when this debt flattens out, when economies start taking on less debt, this is actually not that good for the Bitcoin price action. We can see debt increasing is actually good for Bitcoin. We actually see a bit of a discrepancy between Bitcoin doing incredibly well and economies not doing poorly, but not necessarily doing the most smart thing for the long term. They're taking short-term measures to potentially plaster over the cracks. And we can see as this has started to increase over the past few months very rapidly, the federal debt, it has coincided very nicely with Bitcoin's price increasing from around $25,000, $26,000 only a few months ago to now over double that to where it is today, over $50,000. So ultimately, we need to acknowledge that the good times aren't going to last forever, but given the new macroeconomic norm, which is to just print yourself out of problems, who knows, maybe this bad times actually lead to more good times, at least in terms of Bitcoin price action. This is, of course, ignoring the potential ramifications and long-term detriment that this is going to do to the actual underlying economy. But from a purely Bitcoin price focused perspective, good times might lead to bad times, but those bad times might actually lead to more good times. Also, if you haven't already, please don't forget to like this video, subscribe to the channel, and turn on notifications to ensure you're receiving all of our content as soon as it's released. And make sure to check out all the resources we've discussed today, as well as the many more that are all available on lookintobitcoin.com, your number one source for Bitcoin information. So just to summarize, traditional markets and large global economies are by many metrics not doing so bad and even look pretty good, at least in the short term. But from a broader perspective, there may be many underlying issues with the current economic systems, and historically good times have not lasted too long before the not so good times arrive. However, like we can see, given the recent trend of central banks simply just printing their way out of problems, and the correlation between debt increasing, fiat supply increasing, and the Bitcoin price rapidly increasing, there's a good chance that these further cash injections into the economy will actually result in some Bitcoin price rallies. So we are seeing a little bit of a divergence, a little bit of a discrepancy between stock prices, Bitcoin prices, and underlying economies. But we've known this for a long time, and ultimately you cannot fight the trend. Just because things are bad doesn't mean we shouldn't take advantage. If you like this video, then please visit lookintobitcoin.com, where you can also consider becoming a site subscriber to gain access to professional resolution charts, advanced macro and portfolio data tools, in-depth crypto industry reports, live and personalized indicator alerts, private TradingView scripts, and more, all for a fraction of the standard industry price. And let me know what your thoughts are on potentially having the economy and traditional markets being in a position that is too good that it doesn't almost make sense. But do you think that'll have a long-term good impact on Bitcoin or a long-term bad impact on Bitcoin? Like I said, let me know in the comments down below and on social media. I look forward to reading and replying to all of them. Thank you all very much for watching, and I'll see you in the next one.